What if I told you that the lender may have already been paid for your debt through insurance and they're trying to get paid twice? In this video, I'm going to expose the hidden role of insurance in debt, how lenders protect themselves with financial products you never see, and how this creates a legal opening to challenge collections and even cancel a debt. I've studied credit systems, banking operations, and commercial remedies, and I'm here to show you how debt collectors and banks profit behind the scenes after you default. Now, this is a discussion we heavily talk about on this YouTube channel. So before we dive into this, make sure to like the video, make sure to subscribe to the channel. If you invest in me, then I'll continue to invest in you guys. Number three, thank you guys for watching this video once again, man. If you stay all the way to the end, you will get some game that nobody is talking about. So make sure you stick around all the way to the end, because I'm going to be dropping some key items that talk about the aspect of these banks double dipping and how to be able to overcome that. So let's dive straight into it. First things first, we're going to talk about what happens after you default. We're going to talk about the types of insurance that cover your loan. We're also going to talk about the legal problems in the double recovery aspect. And we're going to talk about what to do to challenge this. All right. So again, stick around to the end, because at the end, you're going to get a special treat to know exactly how to go back and forth with the company if you are in a position where you want to challenge them against a double recovery. So let's dive straight into it. First things first, what happens when you stop paying a loan? Most people think that the lender simply loses money, but the reality is that they don't lose money at all. Not only do they make money up front because of the promissory note, which is the promise to pay note that they use as a financial asset and resell, they also put in position where in many cases they don't really lose, okay? They actually cash out, okay? Because when you look at credit is insured by the government, okay? So understanding that, just understanding that this is a fiat system, this is a monopoly game, okay? Debt and credit is not inherently real. It's literally created when we sign these loans. It's created and it's literally made out of thin air. It's really nothing that they risk, okay? But even on that aspect, if they are able to show that someone didn't pay back a loan that they didn't inherently get loaned, then lenders can file a credit insurance claim. They can do a default swap. They can do FDIC reimbursements or even write it off on their taxes. So here's the question. If they get paid by another source, why are they still coming after you? A lot of times when you get a debt that is charged off, they'll still send it to a debt collector. They'll still send it to a third party debt buyer. They'll still send it to, they'll still even send you letters after the fact. You know what I mean? And this is where the fraud happens. This is where the double recovery happens. This is when the double dipping happens. And then they also don't even disclose that they make money on top of, they don't disclose that they make money from the very beginning. So there's a lot of fraudulent practices that's going on, and we're about to go ahead and break down the different types of insurance that cover your loan. First things first, let's talk about the credit default swaps, okay? Credit default swaps, which is when big lenders use these to hedge risk, meaning if you default, they get paid. So just to explain what a credit default swap, what Google says, okay? Because a lot of people think I make this up, but I'll just go ahead and put it straight in Google, okay? So boom, a credit default swap is a financial derivative that allows an investor to swap or offset their credit risk with that of another investor, okay? A credit default swap is a financial swap agreement that the seller of a CDS will compensate the buyer in event of a debt default, okay? So understanding that this is an aspect that banks insure their loans, they can make it about you defaulting and then they can go and try to sue you after the fact. But there's a law put in place that which is the holder in due course law, that essentially says that once the debt is settled, then it doesn't even have legal standing. Okay. So that's just one way that they cover your loan. The other way is through credit insurance. Okay. Some loans come with policies that pay the creditor off in case of default, death, or disability. The insurance game is very deep into the credit system. Okay. And a lot of people don't know that insurance is actually a type of credit. So with the right terms, they can easily make money off of you defaulting. Okay. So under the credit insurance. Okay. We'll also Google that as well so that you guys, can see for yourself. Credit insurance is an insurance policy that is directly connected to a loan, credit card, retail purchase that is financed or other debts. Okay. So here's the thing. Banks can use this to their advantage. As a matter of fact, they already have this put in place because there is a chance that that person can default, especially when they look at your especially for people who have bad credit or isn't deemed credit worthy. They may automatically put these credit insurance premiums on these accounts prior to from the very beginning of the loan. And it's not really much cost to them because they make money when you guys sign for those loans. Okay. Then we talk about one of the most common ones, and this is where we see all the time, which is FDIC loss sharing. Okay. So, and this is for most banks. Okay. Most banks are FDIC insured. Okay. And let's just see if I could just show you guys. I know you guys have seen this all the time. FDIC insured, credit unions. You'll see this probably when you go on that banking website. Okay. So typically most lenders are federally insured, so they will be reimbursed for the loss. Okay. And this just goes hand in hand with that full faith and credit. This just goes hand in hand on government guaranteeing your credit because, I mean, when you think federal, you think government. Okay. And insured means guaranteed. They're guaranteed and insurance. A guarantee and insured is almost the same thing. Okay. So when you see FDIC insured, just know that if you were to default on the loan, they're going to be reimbursed for the loss. So technically they don't lose at all. Okay. Then we dive into bonding and surety. Many banks are bonded, and if the loan goes bad, they file a claim. Here's the aspect of that. Understanding a bond and surety bond is a financial guarantee. So it's very similar to the FDIC insured, but it's a little bit different. It's usually backed by an insurance company or a bonding agency that protects the lender in case a borrower, you, defaults or fails to meet obligations. So it's like an insurance for the lender and not really for you. Okay. So here's how it works. A bank or creditor is bonded, meaning they have a surety bond in place to cover potential losses required for some lenders and loan servicers to operate legally. So most lenders essentially need this. Okay. Number two, if you default on a loan, the lender doesn't necessarily lose money out of pocket. So that's the other aspect. Number three, instead, they can file a claim against their bond and surety company and get paid to cover the loss. That's three. And then four, once they're reimbursed, the debt is technically satisfied. Okay. But many still try to collect from you anyway, illegally or deceptively. So usually after this, they'll go ahead and sell it off to a debt buyer or a collection agency, and they'll try to come after the money. But there are some cases where the banks will still actually come after you even after the debt is satisfied. Okay. So here's the problem. If a lender is paid by a surety or bond, then sells or assigns your debt to a third party, and that party tries to collect again, this creates a double recovery and is legally and ethically questionable. Okay. You can easily challenge a debt collector that tries to come after you after a debt was satisfied through a surety bond or any of these insurance claims. Okay. But then we dive into the aspect of, here is like a real world example. Okay. Let's just say you defaulted on a $10,000 private loan. Okay. The lender files a claim with their bond and they get paid the $10,000. Okay. They then sell the account to a debt collector for $500. Okay. And the collector now comes after you for the full $10,000. That's a clear case of double recovery and possible FDCPA violations. So, understanding the aspect of debt collectors still coming after you for debt that was already satisfied, that is considered double recovery. And this could be in case of unjust enrichment, no standing to collect, or fraudulent misrepresentation. Okay, you have to tell me that you bought this debt for X amount of dollars, or how you even obtained this debt. Okay, and if it came to a case where you wanted to get them off your back, you can really settle for that $500. Okay, now remember, this is not legal advice. All my rights are reserved, so don't do this unless you understand the risk or you connect with a legal representative. Okay, also, at the same time, we talked about securitization pools where loans are bundled and sold to investors with insurance backing the expected return. So a lot of times they really sell, like when you think of mortgages, they sell it as mortgage-backed securities to investors, to Wall Street, and they make money from the beginning. Okay, they sell your promissory note, they sell your original note, or securitize it, and essentially they make money. Okay, because these are financial assets, but they'll make it seem like it's just a contract that you signed between you and them. But a lot of people don't know that when it comes to contracts, it has to have, number one, a meeting of the minds. It has to be between two of the same entity. It can't be an actual valid contract, cannot be between a living person and a dead person. But usually when we sign these contracts, we sign it as our financial, or as our fiction, and our fiction is considered a dead entity, and they are also considered a dead entity because they're also fictitious. But when you actually come to the forefront and you put out there that you're a natural living breathing person, or you challenge them from this angle, then it's not really a valid contract. Okay, so nor does this negotiable instrument become enforceable. Okay, so understand, when they make money not only from the beginning, but they make money even on the back end if you decide not to pay back the loan. Okay, and paying back the loan is really subjective, because if you gave them a promissory note, that is a negotiable instrument that they use as a financial asset. So them saying you didn't pay it back really is just them making it seem like you had to pay them back in the first place. But we're going to talk about the things, the aspect of how this becomes a legal problem and the double recovery, because a lot of people will say, well, they do this anyway, and the courts will always side on their side and things of that nature. But there are some violations in the laws that you can bring up that cannot be overlooked. Okay, so when we talk about double recovery, if they've already been paid by insurance, they cannot legally collect from you again. They also cannot sell a debt to a collector, and they cannot report it as unpaid without disclosing the insurance claim. Okay, so this is called double recovery, and it violates multiple laws. Number one, unjust enrichment. Unjust enrichment is when they are growing their portfolios unjustly, unfairly. Okay, you didn't even properly disclose any and everything about how you was going to make your money. And then after that, you're trying to make more money unfairly. When all the odds are stacked against me, you're still trying to make more money. Okay, that's the weird part. Then the second part is fraudulent misrepresentation. This is the fraud when you do not bring up specific information, or you omit information, or a debt collector comes from a perspective making it seem like there is money still to be owed, or the debt hasn't already been settled. Now we're talking about fraudulent misrepresentation. And fraud is something that is not cannot be it is taken serious in court. Okay, if you're able to prove fraud, then that debt collector is really in a bad position. Okay, a lot of times we don't want to challenge them on their fraudulent practices, but I mean, it's clear when we look at the Fair Debt Collection Practices Act, the fraudulent misrepresentation is one of the violations that is huge under that. So let's just pull out the FDCPA. Okay, when we go to the FDCPA, straight off the bat, when we talk about the debt collection practices, is pretty much broken down in this subsection under the FDCPA. But one of the biggest things is 15 U.S.C. 1692E, false and misleading representations. Okay, false and misleading representations is The false representation or implication that the debt collector is vouched for, bonded by, or affiliated with the United States or any state using any badge, uniform, or facsimile thereof. Okay, I could be wrong. I could have butchered that completely. Okay, the false representation of the character, the amount, the legal status of the debt. Okay, any services rendered, compensation that may be lawfully received by any debt collector for the collection of debt. Okay, the false representation or implication of that any individual is an attorney or that any communication is from an attorney. Okay, the threat to take action that cannot legally be taken or that is not intended to be taken. Okay, this also goes for you guys. Okay, if you guys plan to go this route, if you intend to take them to court, it's best that you don't just threaten. It's best you actually do it. Okay, and there's more here pretty much broken down. Okay, but the whole aspect of this is very simple in its meaning: false or misleading representation. And when we go back to civil liability, okay, except otherwise provided in this section, any debt collector who fails to comply with any provision of the subchapter with respect to any person is liable to such person in amount equal to the sum of actual damages sustained by a person as a result of such failure. In the case of any action by an individual, such additional damages as the court may allow, but not exceeding $1,000. Okay. This can even dive into a class action. This is what they don't want. But the whole point of civil liability is they have liability to you to not do any of these violations according to the FDCPA. If they're a debt collector, then they must follow these directions. Okay. Then we dive into the Fair Credit Reporting Act. This is when they report negative information on you. Fair Credit Reporting Act. See if I find it. The Fair Credit Reporting Act also gets violated as well because they'll do things like disclose information or report it without providing any and all details in regards to the claim. So putting that report out there that it was insured or that it got settled is something that should be disclosed. Okay, it shouldn't just be disclosed as charge off and something that you still owe, because if that was the case, then obviously somebody will deem it as credit worthy. But also at the same time, banks don't like to see that you'll allow things to go through insurance. It doesn't necessarily mean that it's bad for you, but it's bad for business for them, because if you're a person that's going to actually exercise your rights and not going to pay back allow them to do this double recovery, then yeah, they're not going to want to do business with you. But this is why it's important for you to actually understand the Fair Credit Reporting Act so that you can challenge these debt collectors or challenge these credit bureaus on the information and make sure that they're putting verifiable, non-outdated information and are in compliance with the Fair Credit Reporting Act, because a lot of the things can easily be removed based off of the different provisions under this subchapter. Okay, so now let's talk about what to do to challenge a company that is trying to do double recovery. Okay, so first thing you want to do is you want to challenge them under UCC 9-210. Under UCC 9-210, you want to demand full accounting. Okay, ask where the funds came from and whether a third party was paid. Okay, under this commercial code, you have a right to pretty much ask for anything and everything about the request for accounting, request regarding a list of collateral, okay, request regarding a statement of account, okay, and they have a duty to respond to these requests, okay, and you can go on and take this and read this for your own so you can have a full understanding of this. Okay, I always tell people to not take everything that I say for face value. Go read it for yourself. All right, then we dive into the aspect of you requesting a 1099-C or 1099-A. Okay, if they received a cancellation or abandonment of debt, they may not be allowed to collect. Okay, so ask them for the copy B of the 1099-C, because if it's charged off, then you should have received a copy B. If you send them a letter and you don't get that copy B, then they're in violation. They are not doing any and everything as regards to the Truth in Lending Act, where the Truth in Lending Act requires them to inform you of all their uses of credit. Okay, so that's number 2. Okay, number 3, you want to use conditional acceptance. Conditional acceptance goes like this. accept the debts if they prove no insurance, no reimbursement, or third-party payment was ensued. So if they ever got any type of money, then essentially you don't accept the debt, okay? But you're saying if that didn't happen, then I'll accept the debt, but most likely it happened, okay? If the debt was settled, then there's nothing that you have to pay, okay? There is laws put in place that especially under the holder in due course, that they lose that ability, the legal standing to collect on the debt if it was settled. Okay. Another thing you want to put out there is a file of affidavit of status. Okay. And this is a new term. Declare non-liability and demand verified proof of ownership in claim. Okay. So this goes into the aspect of determining whether they are the person entitled to enforce, determining whether they are the holder in due course, determining whether there is a consideration on the claim itself, okay? And it now shifts the burden of proof onto them, okay? Mixing that with the conditional acceptance really makes a strong argument. And then you want to challenge the credit reports. If they were paid and it's showing negative, that false reporting under 15 U.S.C. 1681. It's important for you to still challenge the credit reports because you can challenge the debt collector, but the credit bureaus will still keep this information on there. If you challenge that debt collector and that debt collector is unable to prove it, once you reach out to that credit bureau and that credit bureau is attempting to say that something is verified, all you have to do is show them the proof of the debt collector not proving what they needed to prove to you. Okay? And again, they have nothing to really stand on if they're put in a position where they try to say that you still have this negative account on your credit report. Okay. So now to wrap up, okay, if they say you owe, they may have already been paid in full without your knowledge. And you have a right to demand transparency, proof, and protect yourself from double collection. That's the whole beauty about this system, okay? Yes, this system may be rigged against you, but you can challenge debt collectors, you can challenge companies, you can challenge credit bureaus, you can challenge debt collectors on their legal standing to either collect on the debt, them reporting negative and inaccurate information on your credit report, or anything that could be detrimental to your person, okay? You have a right to privacy. You have a right to challenge a company on any and all information about that specific debt or loan. There's a thing called the Truth in Lending Act. There's a thing called the Fair Debt Collection Practices Act. There's a thing under the UCC which regulates commercial and contracts, okay? And that's the beauty. Once you know the information, you are put in a position where you cannot be taken advantage of. That's why I love the system, and that's why I love to learn it. And this is why I stay educated on these things, because when I stay educated on these things, then what happens is the banks can take advantage of it. You will never be stuck in a mental slavery. Okay? So now that you got all the way to the end, if you enjoyed the video, go ahead and like the video. Go ahead and subscribe to the channel. Okay, if you want to learn more about this, tap into the Complete Debt Guide. The Complete Debt Guide is only $47. I have all templates, letters, resources, and materials under the Complete Debt Guide, along with step-by-step instruction that dives deeper into the information I'm talking about in my YouTube video. Okay, so tap into that. Anybody who taps into that will be able to sell it as an affiliate. Okay, and make 25% profit on each person that you refer it to. Number two, if you're looking to fix your credit, build business credit, and then also at the same time grow and scale your business, and only if you're trying to do these three. This is not a debt discharge mentorship, okay? If you are looking to understand debt discharge, tap in with the Complete Debt Guide. It's only $47. This is a private coaching experience, and this is specific for people who want to build their credit, get funding, or grow and scale their business. Tap into my one-on-one mentorship down below. You will receive a free training and be able to apply so that you can be able to understand what I offer. But then lastly, if you want to connect with me on a more consistent basis, follow me on Instagram at biz.nick. Okay, I drop credit, legal truth, motivation, mindset, and you're able to connect with me on a more consistent basis. And then lastly, if you ever feel your debt has vanished but then came back from a collector, tell your story in the comment section. Now, I have to go now. Remember to like, subscribe, turn on the post notifications. If you got all the way to the end, comment the word discharge, and I'll see you in the next one.